America's economy is growing at a headline rate of 3.8%, yet federal debt has climbed past 124% of GDP, and Treasury interest costs are now approaching $659 billion a year. As officials tout strength, rising tariffs appear to prop up the books, but also drag down growth and feed local instability. If national prosperity masks so much fragility, why is everyone convinced a crash might be closer than it appears? And where are the real fault lines hiding? The numbers at the heart of the American economy tell two very different stories. According to the Bureau of Economic Analysis, the nation's real GDP grew at a 3.8% annual rate in the second quarter of 2025. This figure, widely cited in headlines, suggests ongoing expansion and resilience. Consumer spending continued to rise, and a drop in imports helped push the growth rate higher. On the surface, these are the hallmarks of a thriving economy. Yet, the federal balance sheet reveals a starkly different reality. The Congressional Budget Office reports that total government debt has reached 124.3% of GDP in 2024, with projections pointing even higher in the years ahead. This is not a distant concern. Debt held by the public stands at 99.8% of GDP for fiscal year 2025, nearly double the average from the past half-century. At the same time, the annual interest bill on this debt has climbed to $659 billion, according to the U.S. Treasury. That is more than the entire budget for many federal agencies combined, and it continues to grow as both debt levels and interest rates rise. These figures highlight a deep imbalance. Even as revenues increased to $5.2 trillion in 2025, spending outpaced them, reaching $7 trillion. The budget deficit for the year totaled $1.74 trillion, or 5.9% of GDP, far above the level needed to stabilize the national debt. While the economy grows, the federal government spends well beyond its means, and the cost of servicing that debt is consuming a larger share of the budget each year. The paradox is clear: headline growth, but mounting liabilities. Tariffs have become a prominent tool in recent United States economic policy, producing a mixed legacy for both the federal budget and the broader economy. In fiscal year 2025, tariff receipts are projected to reach $118 billion, according to the Congressional Budget Office. This inflow adds a visible boost to government revenue, offering a short-term reduction in the budget deficit and helping to fund federal programs. Yet the broader impact of tariffs extends well beyond the Treasury's bottom line. Economic modeling from the Congressional Budget Office and the United States International Trade Commission points to a more complicated picture. While tariffs generate revenue, they also act as a drag on overall growth. The Congressional Budget Office estimates that if current tariffs remain in place, real gross domestic product will be about 0.6% lower in the short run than it would be otherwise. Inflation is projected to be higher as well, with consumer prices rising by an additional 0.4 percentage points, though some estimates place this increase between 0.3 and 0.8 percentage points, depending on how much of the cost is passed on to consumers versus absorbed by businesses. The precise effect of tariffs on prices and growth remains uncertain. Analysts caution that the share of tariff costs paid by consumers, producers, and supply chains can vary widely by sector and over time. Some industries may shield buyers from higher prices, while others may pass along most of the increase. This uncertainty complicates efforts to forecast the true economic cost of trade measures. What is clear, however, is that the same policy that strengthens the federal balance sheet can also create new pressures for businesses and households, especially in regions and sectors most exposed to global competition. In the late 1970s, manufacturing stood at the core of the Midwest economy. Michigan, Ohio, Indiana, Pennsylvania, and Wisconsin together supported nearly 19.5 million manufacturing jobs across the country, according to the Bureau of Labor Statistics. Factories, steel mills, and assembly lines shaped daily life and underpinned local prosperity. Over the decades that followed, this foundation eroded. By 2019, manufacturing employment had dropped by about 35% from its peak, and the number of manufacturing firms nationwide declined by more than 1/5 between 2002 and 2022. In these 5 states, manufacturing still accounts for more than 15% of state GDP, double the national average, leaving their economies especially exposed to global competition and policy changes. Cost increases from tariffs, along with rising input prices and shifting trade agreements, have made it harder for local firms to compete. As a result, these regions remain highly sensitive to external shocks, with each new disruption threatening jobs, business survival, and the stability of local communities. Labor shortages have become a defining constraint across several sectors of the United States economy. Immigration policy changes and increased enforcement have slowed the flow of new workers, especially in industries that depend on foreign labor. Department of Labor audits and reports from the National Association of Home Builders show construction sites in multiple states experiencing project delays or stoppages due to unfilled positions. In manufacturing, plant managers report persistent understaffing, with some facilities operating below capacity for months at a time. Agriculture faces similar pressures, as farmers struggle to secure enough seasonal workers to harvest crops. The United States Citizenship and Immigration Services backlog for employment-based visas has increased by 35% since 2022, leaving thousands of applications unresolved. These delays ripple through supply chains, stalling production and raising costs for producers and consumers alike. The combination of policy-driven labor constraints and operational bottlenecks has created a second vulnerability channel, one that is not driven by prices or tariffs, but by the simple absence of workers needed to keep projects and production lines moving. Cash receipts for major crops in the Midwest have fallen by $6.1 billion this year, according to USDA Economic Research Service. In Iowa, Nebraska, Kansas, and Illinois, farmers depend on selling corn, soybeans, and wheat into global markets. With prices down, the value of those crops has dropped, and expectations for future income have fallen. As prices slid, futures contracts at the Chicago Mercantile Exchange triggered a wave of margin calls. Many producers who hedged their harvests found themselves forced to post more collateral or sell positions at a loss. For operations already carrying high debt, this sudden demand for cash has become a breaking point. Bankruptcy filings among farm businesses in these states are rising, as documented by federal court records and USDA tracking. The consequences reach beyond the farm gate. More than 30% of all agricultural loans in Iowa, Nebraska, Kansas, and Illinois are held by community banks, according to FDIC data. When farms default, these banks absorb the losses. As non-performing loans mount, bank balance sheets weaken, and the risk of credit tightening grows. This chain reaction, crop price declines, margin call distress, bankruptcies, and lender exposure, turns a rural problem into a threat for the broader financial system, especially in regions where agriculture anchors the local economy. Florida, Nevada, and Arizona have seen household debt loads swell over the past decade, shaped by years of easy credit and rapid population growth. According to the New York Federal Reserve, the share of credit card and auto loan balances at least 90 days delinquent has climbed steadily in these states since late 2023. In Florida, the 90-day delinquency rate on credit cards reached 8.1% in the first quarter of 2025, while Nevada and Arizona both reported increases above the national average. Rising interest rates have pushed debt service ratios higher, with households now spending a larger portion of their income on monthly payments. Wage growth, tracked by the Bureau of Labor Statistics, has not kept pace with inflation in these regions, tightening budgets further. As more borrowers fall behind, local banks and lenders face mounting risk, with consumer stress threatening to ripple through the broader financial system. California, Washington, Massachusetts, and Texas have become magnets for artificial intelligence investment, drawing billions of dollars in venture capital over the past 2 years. Many firms at the heart of this boom operate with negative cash flow, relying on outside funding to cover payroll, research, and infrastructure. Crunchbase data shows a surge in venture capital deals across these states, but also a growing dependence on continued access to capital. Recent surveys from the Federal Reserve's Senior Loan Officer Opinion Survey confirm banks are tightening lending standards, especially for speculative technology and startup borrowers. As credit conditions stiffen, even well-known AI companies face delays in raising new funds or are forced to cut back on hiring and expansion. The rapid growth that drives national headlines is closely tied to the availability of borrowed money. If capital becomes scarce, these technology hubs could see a sudden slowdown, with ripple effects for suppliers, workers, and local economies. Even as national numbers impress, nearly 60% of Americans now say they feel financially insecure, a sentiment echoed in rising delinquencies and regional job losses. When local cracks appear in a globally linked system, stability is never guaranteed. The next stress test may not wait for the headlines. Share your thoughts below.